Obvious looking yield curve, if you will. How steep is too steep for the Fed? When do they start to think about the front end?
Oh, I don't think that they'll worry too much about that, at least for another 50 or 100 basis points and say the 2-year versus the 10-year. At 110 basis points, 120 basis points, that's not a crazy steep yield curve yet. You get up toward 200, that's typically around the level that you get when the Federal Reserve starts to hike. Now, I actually think that we won't actually ever reach that level this particular cycle because I do think that the market is going to keep on pricing for the Fed to hike maybe to 1 3/4 or 2%. It's not going to price for 2.5%, 3%, or 4% federal funds rates. So because of that, there's probably a limit to how high the 10-year can get this cycle.
And you kind of heard Janet Yellen say just that interest rates are going to stay low for a while. So your description
of both the Bank of England and the European Central Bank. So those hawkish statements is saying maybe at some point we're going to hike. And, the market's even pricing for like a whopping 10 basis points, but nonetheless pricing for 10 basis points of hiking by the ECB over the next year and a quarter or so.
For the U.S. market, Ira, where does the debt ceiling crisis factor in here? It does feel a little bit like the Congress that cried wolf, but at some point, of course, it is a crisis.
So not in what we were just talking about, the long end of the curve, because I think that, risk off will probably keep yields a little bit lower. And I actually think we could see a little bit more of a sell-off if we get the debt ceiling. But in the T-bill market, you definitely see it. Every single T-bill that winds up in the crosshairs of the debt ceiling that might see a delayed payment continues to trade cheap, and sometimes at 2 or 3 times the yield of longer-term T-bills. So normally, of course, you have a nice upward sloping yield curve. Now you have this big kink in that yield curve, and that's because of the debt ceiling. And today, when Janet Yellen sent a letter to Congress saying October 18th is the date, you saw the October 19th and the October 21st T-bills, gap wider in terms of their yield.
Yeah, good stuff. Also, Ira, we got to talk about your background at some point because I don't know what that is, but it makes you look really cool. Ira Jersey,
soccer scarves, all soccer scarves.
Ira Jersey, Bloomberg Intelligence Chief U.S. Rate Strategist. Good to see you. Okay, well, for what it's worth, I want to take a check on the U.S. economic data that we got out today. So first, U.S. home prices surged almost 20% in July, once again posting the biggest jump in more than 30 years. The demand destruction is already there. The cure for high prices is high prices, but we're still seeing them as those kind of prices wind up outweighing and sort of pushing out new home buyers, et cetera. Then they go to the rental market, and then it continues. Also, Amanda, we had that consumer confidence drop in September as well, and it just also raises the question of the pressure that consumers here in the U.S. are going to be under.
Yeah, and we've seen a little bit of wearing for that U.S. consumer, which is obviously a dangerous signal for what lies ahead. On the housing front, affordability is the key question. But we should also, of course, remember the flip side of that is for everybody in a home, the wealth effect is fairly serious. And, of course, across Canada and the U.S., the majority of people are in homes already. So it's an interesting kind of trade-off on affordability versus people feeling better off, at least on paper.
Yeah, true. Although you have to sell it to get it. I mean, it gets a little complicated when we hit that. All right, well, coming up, we've got Amazon's hardware launch events underway. We're going to break down the latest lineup with Dave Limp, Amazon Senior Vice President of Devices and Services, coming up next. This is Bloomberg.
Boosters work, and they will definitely help. The boosters, both the Moderna and the Pfizer booster, take antibodies back up to at least where they were, and probably twice or 4 times where they were at the peak. It's definitely teaching your immune system to recognize Delta better. The antibodies that people are making after a booster, they are better antibodies. And they're also probably then better antibodies at recognizing other variants in the future. If you get infected once, your immune system says, all right, here's how much I want to set aside of memory, right, to not get that again. You get infected twice, your immune system says, well, that didn't work, right? It should probably up that some. You get infected 3 times, immune system like, all right, this is a problem. It's really worth not getting sick anymore. And so the vaccines are essentially that, right? And if the immune memory was pretty good after the second one, what's probably going to happen after the third one is that it's going to be more stable. Even if the peak is the same, you're going to keep more of it for a longer period of time. It's a race, right? It's a race between the virus and your immune system.
From New York City,
in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
We are in a debt trap. It's not just fiscal dominance, but when central banks are going to want to essentially phase out unconventional monetary policy, given the debt ratios, there is a risk of a crash in the bond market, in the credit market, in the stock market, in the economy.
This is Bloomberg Markets. I'm Amanda Lang alongside Alex Steele, and we wanted to take a quick check on tech stocks here. We are still seeing, of course, a sell-off in equities responding, Alex, at least in part, to that jump in yields on your 10-year. Here's a look across the group. There's the NASDAQ 100, and Amazon down 2.8%. Apple actually faring better than some, we should note. I saw Google last check down more than 3%. It is one of those days when you're seeing big momentum moves.
Yeah, exactly. And I think it's not only higher yields, but it's also these supply chain pressures. If you wind up having power issues and certain plants and certain industries in China having to conserve power, that's going to have like a feed-through effect into some of these guys. That's probably why, in essence, you're seeing the semis down as well today.
100%. We'll watch Micron, of course, and find out what it has to say. Lots to be said about Amazon today. Its hardware launch event is underway, and Bloomberg Technology's Emily Chang is standing by with us with a key voice from that event. Emily?
Thank you so much, Amanda. Dave Limp, Amazon Vice President of Devices and Services, with us now after unveiling a slew of new products and services. Dave, great to have you back here on the show. I want to start with the Echo show, this wall-mounted Echo with a much larger screen that you imagine being a sort of family connection hub where you can share calendars. It could also double as a kitchen television, for example. How do you imagine this changing the family dynamic of the future?
Yeah, as a parent, I've lived through the life of trying to juggle 3 kids, shuffling them around to various soccer games. And our kitchen was a montage of sticky notes and things on the refrigerator. And, technology can help solve that. And we think this idea of ambient intelligence and something that's hanging on your wall can not only entertain you through television, but at the same time can help you get more organized by, common family calendar and to-do notes and those kinds of things done in a sort of new way, in a 21st century way.
The biggest talker has to be the Astro robot, sort of a step beyond Alexa on wheels. We have seen robots like this unveiled in China, and I'm curious what the data is telling you about whether or not consumers really want something like this, and if you see this becoming a mass market consumer device.
Well, as you said, Astro is our new robot that we launched today. It's always a good day when you get to launch a robot. And what it is this idea that that we can do more if we can bring technology to you in an ambient way throughout your house. So it's mobile, it can travel throughout your home. And I've had it, I guess, on and off for about a year now. And certainly the home security use case resonates very, very highly with me. You don't necessarily want to put cameras in every room of your house, and this way it can patrol through your house when you're away. And also the idea that it might give you peace of mind. So giving this to my father, who's 85, you know, I love him. He's very mobile, but giving me the ideas and reminders that he's up and about, and being able to communicate with him in an instant, and with Alexa together to have the ability for him to call if anything might go awry.
What does the update cycle look here? I mean, A, does the price come down below $1,000? Do you add arms to this device? Does it, you know, go up and down stairs eventually?
Well, I think with the technology that we have today, a single floor robot at this price point it was incredibly hard to invent. I will tell you that it was not easy. There's a lot more power inside of this than's in your high-end smartphone that you have today. It's packed full of AI technology, also has wheels, motors, safety systems. I think long-term, though, if you look at a 5 or 10-year horizon, the pace of invention around AI, around robotics, will allow us to do more. Now, whether or not we get to stairs at that particular point at an affordable price, I'm not sure yet. But I do know that the pace of innovation around robotics is accelerating, not decelerating.
How do you think about whether all of this technology in our homes is actually good for us, or if it's encouraging, you know, an over-reliance on devices and, you know, not enough using our own brains?
Well, I'm an optimist, first of all, but I would also say that's kind of what we see. We share that view in that technology should not always be front and center. I used an example today that, you know, I often go home and all my kids are in corners of the house, you know, staring at their phones, and I'd rather have them heads lifted up, enjoying what's going on around us. So what we're trying to invent with this idea of ambient intelligence is, yes, we're using technology, but we want it to fade into the background. When you're not in front of it, it doesn't have to be front and center. It's like our original device, the Kindle. It just faded away. It lets you get lost in your author's words. So too things can around your house do that as well. And when it's working, you'll know it, because customers, your family, you can be enjoying music all together. You can watch a movie together. You can be communicating with a new product like with Amazon Glow together. And when you're not using the technology, like I said, it fades away and you don't have to worry about it.
You know, I want to ask you about technology because you did talk about privacy a number of times here, but there seems to be this broad distrust of big tech in general right now and data collection overall. Amazon is facing a number of different complaints about how much information Alexa is collecting about them. How do you earn that trust while rolling these devices out simultaneously?
Well, I think you said it well, which is we have to earn trust of our customers every single day. It's not something that you get to put in the bank and hold for a long period of time. We have to always be earning trust. And to do that with these kind of products, also true of phones and consumer electronics in general, is I believe, and we believe, that you have to make privacy and security foundational of these products. It's just at the very core of everything that we do. And the form that takes for a customer is give them control of their data. Let them be able to delete it whenever they want. Let them automatically delete it at 90 days or 180 days if they so choose. If we do have cameras in the home, let's put shutters in front of the camera so that when they're closed, a customer can have peace of mind that there's not a camera there. And the list goes on and on, but we have to constantly be inventing new ways to earn that trust, and that is by making sure privacy is front and center.
All right, Dave Limp, Amazon Vice President of Devices and Services. We will, of course, be watching how all of this rolls out. Thanks for joining us from the kitchen of the future there. Amanda, I'll send it back to you.
All right, Emily, thanks so much for that. Bloomberg's Emily Chang with Amazon's Senior Vice President of Devices and Services, Dave Limp. And just some breaking news here. A lot of focus on the debt ceiling. It's been called a crisis. And now some comments from an influential voice, Jamie Dimon, telling Reuters that he does believe that that crisis will be averted, but that JP Morgan is preparing for a default. He says that it would be catastrophic if there was a failure to address that limit. We will stay on top of that. Coming up, we're talking about the energy crisis in Europe. It is, of course, cause for great concern. Anna Mikulska, Energy Studies Fellow at Rice University, is with us next.
Can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kayleigh Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Markets. I'm Alex Steele with Amanda Lang. So Brent oil falling a bit from that 3-year high above $80 a barrel, kind of unable to withstand that pressure of U.S. equities heading for their biggest decline since May. Let's get some more insight now with Anna Mikulska, Energy Studies Fellow at Rice University's Baker Institute of Public Policy. Anna, what price is too high, and we start to see demand destruction or an OPEC response?
The price is too high when countries don't necessarily want to pay. We've seen a resurgence of economies all around the world, and there is a good chance that many countries can still pick up a relatively high price. And depending on which economy is able to, to take more oil, we will see it. Basically winning the oil wars if it's for the price. Not sure about the demand destruction at some point, definitely, since we are still not out of the pandemic. And that's kind of what complicates all of the above. Mm-hmm.
When it comes to natural gas, of course, there are some real complexities, especially in Europe right now, Anna. Russia stands to hold an awful lot of powerful cards in the natural gas game. What is going on in terms of its pipeline to Germany and the natural gas supplies in Europe right now?
So it's really in Europe when it comes to natural gas, it's the perfect storm. We've seen demand soaring, both internationally and in Europe post-COVID, and additional supply, discretionary supply that would otherwise come from LNG spot purchases are not coming there. And that's what's missing for the continent, not only to be able to feed its supply now, but also to fill up the storage that has been depleted over the last long winter, and that was not restored to the same levels as usual it would be through the summer.
Anna, the crisis that we're seeing in terms of power and gas in Europe and the UK, what's the potential for that to take place here in the U.S. and elsewhere like Latin America and Asia?
So the U.S. is in very different situation that Asia or Europe is. It's market where natural gas is produced, from which is being sent. So the prices are also very different. They are higher than they were when the demand, both internationally and domestically, was not as high. But as we move into the winter, U.S. as everybody else is trying to replenish its storage and kind of prepare for the winter. And now, depending on the winter, we'll see whether the prices are going to be soaring in the U.S. and internationally. We do see very high prices in Europe and Asia, higher prices here. This will probably continue since it is not an easy fix. We cannot just activate right away additional supply. And also, when you think about it, U.S. is not, perfectly interconnected internally. So there are pockets of natural gas that are not able to go through to another part of the country. And, we will end up with shortages there. And,
All right, Anna, so good to have your thoughts on this. Anna Mikulska of Rice University's Baker Institute of Public Policy, thanks for that. And, of course, those commodity prices are playing into the mix here. Alex, we watch markets as we go. They continue to trade lower. We'll watch that final 30 minutes of trade and see if we see a turn for the better, as you sometimes see. For Alex Steele, I'm Amanda Lang. This is Bloomberg.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
We have a surge in demand. As you know, we had a lot of fiscal support, and that's, we've passed the peak, and that means it will also fade away.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I'm Mark Crumpton with Bloomberg's First Word News.
Senate Republicans have blocked a bill that would suspend the debt ceiling until December of 2022. It would also have the government operating past the end of the fiscal year later this week. That increases the pressure on Democrats to find a way to raise the debt ceiling and avert a default. They now may have to use a budget procedure that could take nearly 2 weeks. The trading scandal that rocked the U.S. Federal Reserve now offers the chance to reshape it. After 2 regional chiefs quit, there are now 6 top jobs open at the central bank. The presidents of the Fed branches in Boston and Dallas, Eric Rosengren and Robert Kaplan, have announced their retirements. That's following embarrassing disclosures about their trading activity last year. The Taliban's appointed chancellor says that female students won't be returning to Kabul University until, quote, a real Islamic environment, unquote, is provided. The militant group has said that women won't be allowed to work and study within the bounds of that interpretation of Sharia or Islamic law. But so far, there's been no moves to restore freedoms to women and girls. Japan will lift a virus state of emergency at the end of this month as new COVID-19 infections recede, easing restrictions that have dragged on the economy and limited operations at bars, restaurants, and entertainment venues. Prime Minister Yoshihide Suga said he would end the restrictions on Friday for Tokyo and 18 other areas that make up about 75% of Japan's economy. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
The most crucial moments in the trading day. This is Bloomberg Markets The Close with Caroline Hyde, Romaine Bostick, and Taylor Briggs.
It's 2 p.m. in New York, 7 p.m. in London, live from Bloomberg World Headquarters. This is Bloomberg Markets The Close. I'm Romaine Bostick.
I'm Shonali Bassick, in for Caroline Hyde. I'm Taylor Riggs.
All right, well, cue up the cellos, fire up the oboes. The stock sell-off deepening, traders shifting their duration. The quant value trade getting another moment in the sun. What's driving that volatility? Where investors should look next? Fei Li, the head of equities over at Research Affiliates. She's going to be joining us to give her perspective. Plus, Yellen setting the date. The Treasury Secretary warning that her department will effectively run out of cash around October 18th unless Congress acts. We're going to discuss directions across bond markets with Jason Bloom, Invesco head of fixed income, and the price squeeze in oil and gas. No signs yet of a reversal. A supply-demand imbalance teetering here as we head into the winter season. Senior energy trader Rebecca Babin, she's going to be here to give us her outlook. All that and more coming up shortly. But first, let's get a check here on the markets. Of course, we talk about this stock sell-off yesterday, a stock sell-off that, of course, is deepening here on this day. And I guess at some point, it's not really about the rotation anymore. You remember, of course, we talked yesterday about how the cyclicals were getting that bid. You're not going to find any real safety here on this day. This is not quite a 90% down day just yet, but pretty much 80% plus of all the members of all the major indices are in the red here on this day. And as far as correction territory here, we're down about 4% on the S&P 500 from that all-time high back on September 2nd here. But more importantly here, when you look underneath the hood here, you're talking about 45% of the members of the S&P 500 right now, down about 5% or more. So whether you're looking at a 10% correction as the threshold or 5% as the threshold, you're still talking about almost a majority of the stocks right now in the S&P 500 heading towards some sort of technical marker here or big rally here in the dollar. You're seeing the VIX elevated. And, of course, right now, Taylor, it's all about the treasury.
You going there? We're going to do yields.
Are you going to get there?
We're getting there, Romaine. I first want to start, though, with some of the economic data that we got this morning. Home prices are up 20% year over year. Consumer confidence that we're showing here starting to come in a little bit soft, right? As you're thinking about some of these maybe inflationary pressures that are underway, consumer confidence slipping more than expected to the lowest since February. What that means is what's interesting, Romaine, as you've alluded to, it's not bonds that are catching a bid. It is that inflationary trade, at least within the bond market, that is back in vogue. Take a look at this terminal chart here. You know, have 10-year yields rising for 4 straight days in a row, pretty much across the board. Here's the interesting fact. The 2 and the 5s, They're their highest yield since February and March of 2020. You had a 7-year auction that was decent. Some are saying soft, some are saying decent demand. But that 7-year yield is now the highest since March of this year. And you have 10s and 30s that are climbing, and it sort of brings up a rate of change kind of day.
Yeah, you're talking about a 5-year yield that just a couple of weeks ago, of course, was below 80, I should say here. It'll be interesting to see where this leads us. Let's get some perspective right now from Fei-Fei Li. She's head of equities over at Research Affiliates. Fei-Fei, always great to get your take here, particularly from a shop like Research Affiliates. And, you know, I know that there's not always a direct correlation and a direct agreement about how much bond yields feed into the movements that we're seeing in equity markets. But I am curious that when you look at what's transpired over the last couple of weeks here, how much are you linking those two?
Well, there is no very tight link, especially at Research Affiliates. We do, style investing, factor investing. We did look into historical data. When we petition the sample based on different, regime for interest rates or the direction of interest rate movement, you don't see a, big difference between value stocks versus growth stocks, what kind of premium they offer. So historically, I think it's relatively weak. However, when we think about what's happening today, I think it's actually we are getting back to more like normal economic regime. During economic recovery, we do observe bond yields are supposed to rise together with inflation. But over past 2 months, the 10-year yields has been going down when the inflation number keeps going up. I think there are just, two factors maybe contributing to this. One is flight to safety. Investors' expectation on growth slow down due to the Delta variant, and also, the Chinese markets due to the government regulatory crackdown. So investors are getting out of that market into U.S. or developed equity markets. Well, the second factor is really Fed, purchasing very large quantity of treasuries, and this will also kind of diminishing when they start tapering.
Fei-Fei, we still have the major averages all in the red today. How much worse does it get from here is the big question.
This is a $1 million question. It's really hard for me to predict the magnitude of where this is going. But I would just say a major market pullback, by more than 5% in a row is not uncommon historically. If you look at year-by-year data, almost every year S&P 500 experienced, more than 5% pullback 3 or 4 times on average. And this year we haven't experienced any. So I think, the market might be a little bit surprised about how fast the yield jumps to a certain level, but that's actually common when we put it in the context of historical data.
I am curious then why today we're not seeing some of the reflationary, inflationary stocks. You're even thinking like a Russell 2000 being the big outperformers, if that's the reason why bond yields are rising. What is the long-term case for this reflationary trade?
Well, I think, we try to link, again, the long-term perspective with a valuation multiple, because in our empirical study, valuation multiple is actually the only robust indicator about long-term performance of equity stocks. When you look at the macroeconomic variables, they have very weak predicting power. When we look at valuation multiple, certainly it is value stocks. Small cap stocks, especially small value, actually give you maybe the strongest combination to outperform large cap U.S. stocks in the future.
Fei-Fei, I want to get your take on what's been happening overseas, because it seemed like some of the concerns in U.S. markets and as well as European markets, a lot of this seemed to start because of some of the concerns about what was happening in China, the crackdown going on over there, and particularly some of the concerns about the stability of Evergrande and, of course, the property sector here. What are you generally expecting right now with regards to the future of Evergrande, and whether you anticipate any contagion risks?
Sure. I'm actually very glad to see the market seems to be a little relieved, at least from last Thursday, regarding the Evergrande's impact on the global financial system. I don't expect it would have any serious ripple effect. I think out of the $300 billion debt, Evergrande has, actually only 20% is through bank loans. So the scale is not very big. It's unlikely to have a very severe impact on the Chinese banks, which are the real systematic financial intermediaries. And also, I think the Chinese government has certain advantage in dealing with such a crisis because they have very centralized power. They actually could really play a role to stabilize the situation and provide sufficient support. Lastly, I do think, the Evergrande episode is a very important landmark. It indicates a golden era of investing into China's property market is over. In the next few years, unlikely we will see property price going up significantly like what we have seen before, partially due to the government's regulation to prevent speculation, partially due to, the credit tightening to developers, and also investors' fear coming from Evergrande will reduce their willingness to purchase.
Romain a little earlier had mentioned this jump in the VIX. It's actually a 23% jump, almost 24% jump that we're seeing today alone to 23, over 23. Is there a level of volatility that would start to concern you?
The volatility, I think, is actually very, very high ever since the start of the COVID. We basically entered a high volatility regime. We have a big daily return swings into both directions in last year. This year, the market actually has been quieter, in my opinion, versus last year. So I think this type of vol is what I will expect, especially when we reach a high valuation multiple. The market seems to be, less stable. People pay attention to what might go wrong.
Feifei, always great to get your insights here. Feifei Li, of course, head of equities over at Research Affiliates, helping kick off the show. A lot more coming up. We're going to get some more insight on what's going on with that rise in Treasury yields and the impact on investors. Jason Bloom, head of fixed income at Invesco, going to be stopping by next. Plus, Janet Yellen putting pressure on lawmakers to lift the debt limit, warning the U.S. Treasury it could run out around October 18th, run out of cash unless Congress acts. And fuel prices really skyrocketing. At one point, we saw natural gas prices topping $6. First time we've seen that since 2014 on an intraday basis. We're going to talk about what to expect as the winter months coming up ahead. All that and more right here on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You want to do rate of change, and we'll do it. You're looking at a 10-year yield, Romain, that was at a 130 on Wednesday during the Fed meeting. We're at a 153 right now. And what I like to do is not only talk about nominal, which is in blue, but the breakdown, because inflation in the break-evens in yellow, it's actually been relatively steady. So a lot of the nominal move upward has been a movement in the real yields that are now becoming less negative. Let's get more insight into this with Jason Bloom, head of fixed income and alternatives product strategy, ETFs, and index strategies at Invesco. And Jason, we've all been talking about a rate of change on why yields are rising, but does the composition and the why behind that rate of change move, does it matter?
Yeah, I think it does. I think it does. Everybody has been almost perplexed and sort of wondering out loud, how long can real yields stay as negative as they are? And I think the answer is really that there is no answer, in that sense that part of it is simply technicals. It's flows. Like, people say, well, where should the 10-year yield be? And I'd say, well, it doesn't really matter as long as Bund yields and JGBs are paying zero or negative yields. Then there's only so far that 10-year Treasury nominal yields can go before the leash pulls tight and the relative value kicks in, and foreigners, buy U.S. Treasuries at substantially higher yields, and that demand will essentially cap the move up in 10-year yields. And it doesn't really have much to do with where should rates be. When you're getting essentially QE and the massive distortions from QE in Europe and Japan are flowing over here to the U.S. So the U.S. had its own version of QE that was further suppressing yields. With the tapering, they're pulling back, and the market is reacting to that signal now. But in our view, there isn't that much further for 10-year yields to go before essentially the leash from QE in Europe kicks in.
We've been asking this all week, Jason, but what does this mean for some of the more sensitive assets out there, particularly junk debt that has been filling investor pockets to records again this year?
Right now, nominal yields are still really accommodative, albeit higher than they were for the last year and a half. I don't think we are at a place now where you're going to see an impact on the corporate credit borrowers here in the U.S. I think, though, that one of the dangers that we're seeing as yields do now begin another leg higher in the U.S. is that to the extent it drives a move higher in the U.S. dollar, that could start to stress emerging market countries because they borrow so much in dollars, and their debt burden grows as the dollar rises in value. We saw that play out in a few different cycles over the last 10 years. So in the midst of EM struggling and lagging the developed world in recovering from COVID, if you were then to see say another 5% move higher in the dollar from current levels, now they're going to be getting hit with a real double whammy, and it could be very disruptive in many different ways. You layer on top of that higher energy prices, unless one of those countries is an energy exporter, you're adding another drag, right, onto their growth, and we start moving closer to stagflation.
So, Jason,
globally.
We've already started to get a little bit of a move on that dollar. I mean, at one point on the day here, we saw the BBDXY as well as the Dixie hit new year-to-date highs. And I'm wondering that when you look at the moves that we've seen over the last couple of months in the dollar relative to the rest of the world, and you look at some of the moves that we've seen other central banks make, meaning outside of the U.S. and Europe, do you think that it's possible for some of those central banks to stay ahead of this?
They're in a real pickle because of these supply chain disruptions. Essentially, now we're getting one supply shock after the next. And if you want to draw parallels to the stagflation of the 70s, we don't yet have the union labor-driven wage price spiral. But we do have supply shocks, and the supply shock of the oil supply shock of the early 70s was a big driver of that stagflation dynamic, and we are alarmingly moving in that direction. You look at nat gas prices in Europe, for example, they're already on the cusp of a recession being driven by the shock in energy prices there, let alone the humanitarian cost if you have people freezing in their homes because they run out of heating fuel. These things are pretty concerning. So to your point, like, how could foreign central banks make a move to get in front of that currency depreciation when they're trying to stimulate a growth recovery? It's a very difficult problem.
Jason, just 30 seconds here. Are you looking at spreads to be blowing out or fundamentals supportive?
So far, growth is holding up. I think that we are, again, I think that the supply shocks, though, are starting to present a larger and larger visible risk to the growth picture. Higher inflation and higher growth isn't such a bad thing. The worst of all possible outcomes is high inflation and low growth, or inflation accompanying a recessionary style environment, because commodity costs are skyrocketing because of supply chain disruptions and shortages.
Yeah.
The central bank and even governments at that point in time are going to be run out of tools.
Jason, always great to get your thoughts. Jason Bloom providing some great insights here, of course, head of fixed income and alternatives product strategies, ETFs over at Invesco. We're going to break down, of course, some of the commodity issues he was talking about just a little bit later with Rebecca Babin. That's coming up shortly. Don't go anywhere. You're watching Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
It is imperative that Congress address the debt limit. If not, our current estimate is that Treasury will likely exhaust its extraordinary measures by October 18th. America would default for the first time in history. The full faith and credit of the United States would be impaired, and our country would likely face a financial crisis and economic recession as a result.
Pressure mounting on Congress to raise that debt limit. That warning, of course, coming from Treasury Secretary Janet Yellen earlier while testifying. Anne-Marie Horder, and Bloomberg Washington correspondent, joins us now from Capitol Hill. And some big words, but one that we've actually heard before. How do we think that this time will be different, if it will be?
Well, it does look like we're going to come close to that October 18th deadline that the Treasury Secretary had outlined today, both in those remarks at the Senate, but as well to a letter to congressional leaders. What's happening now is that Senator Chuck Schumer, the majority leader of the Senate, is saying that he is going to address the debt ceiling today in the Senate. And what he's likely going to ask is that 100 senators would have to sign up to vote for this, so it's likely to fail, but to lower the threshold so that the Democrats could, at least by a simple majority, majority pass a suspension of the debt ceiling. Now, already Senator Ted Cruz said he would vote that down, but that would potentially be one path to averting this looming debt ceiling drama. There's a number of paths they could take, and right now there's just a lot of negotiations ongoing about how Congress and the Democrats are going to address this.
It appears right now, okay, the Republicans aren't willing to participate or at least to sort of entertain any of the proposals that the Democrats have put forth here. I am curious longer term, Anne-Marie. I mean, I know that there are some sort of short-term measures that the Democrats can take to sort of keep the debt ceiling, to keep the sort of the debt flowing here. But longer term, is there any real compromise, potential for compromise out there?
It's a great question. Speaker Pelosi today was talking about potentially having the Treasury be the ones to enact it, the Treasury themselves being the ones to raise or suspend the debt limit. Then there's also something I know Joe Weisenthal has been prolific on Twitter talking about, and this is minting a $1 trillion coin.
Yeah.
I mean, but
I saw this.
Hey,
and
listen,
we know Joe Weisenthal.
I know you're laughing, but people are talking about it at the Hill. So
we'll talk a little bit more about that, Anne-Marie, because I mean, we know Joe's crazy, and I mean, a $1 trillion coin, that would just be like manna for heaven from him. He'd be able to write about that for months to come here. But is that something that's seriously being considered by actual, serious members of Congress?
Listen, they can discuss all of that, these future ways to deal with the debt ceiling, just then, in the future, post-October 18th. What's really being discussed is what they do now as they come closer to this deadline. So Senator Schumer's likely going to try to do this one maneuver in the Senate today. Then we heard from the House Majority Leader, Steny Hoyer, who really walked back comments. I have to say, earlier today, there's a bit of confusion amongst the Democrats because he said, we'll have to go via reconciliation. And then number 2, Senator Dick Durbin said, no, that's not an option. So what Congressman Hoyer had now said on Twitter is that is not the option we want to pursue. But we do know that if it comes down to it, the Democrats are the one that have the power at the Capitol as well as in the executive branch. They're going to have to go via reconciliation to do this. But that could be a cumbersome perspective and logistics. So potentially just 2 weeks. All right.
A lot going on down there, Anne-Marie. Of course, you're on top of it. If they come up with that $1 trillion coin, well, you let us know here. And of course, if Joe's watching, calm down. NASDAQ 100 right now. Look at that here. Not really getting much love there. Not really getting much love for the cyclicals as well. And there's your Treasury sell-off. It continues right here. This is Bloomberg.
Companies that can move the fastest and be the most agile, no matter what change comes their way, no matter how fast it comes their way, these are the ones that are going to survive and thrive. China's a good example of that now. You see across the board some of the rules and regulations that are changing, or maybe the uncertainty that's coming out of the Chinese government, and they're trying to deal with some of the local challenges that they have, both in terms of how to manage the asymmetry between the haves and the have-nots locally. They're trying to deal with the issues of managing data and security and other aspects like that. The companies that can operate in China and around the world collectively in a bipolar way are going to be the ones that come out of this on top.
Are investors going to come out on top, though, or are companies looking to do business within China from the United States? Are they going to come out on top for the moment, Bob?
Yeah, it's clear that the investors are in for what I think is going to be a bumpy ride. You see it today in terms of what's happening in the marketplace.
When you went to Harvard Law School, did you say, maybe someday I'll be on the Supreme Court?
Anybody who thinks maybe someday I'll be on the Supreme Court, I don't want to say there's something wrong with him, but there is something wrong.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
I'm Mark Crumpton with Bloomberg's First Word News. New York Governor Kathy Hochul says a COVID-19 vaccine mandate for health workers that is in effect this week is working to boost vaccinations. The governor says it's a roadmap for other states fighting the Delta variant. Hochul's office says about 92% of New York nursing home staff had received at least one vaccine dose as of Monday, and state data shows 84% of hospital staff were fully inoculated as of last Wednesday. Independent investigators mandated by the World Health Organization to probe allegations of sexual abuse by its staff in the Democratic Republic of the Congo have cited, in their words, structural failures and individual negligence in a new report. The abuses were committed by local personnel as well as members of teams in the country to fight an Ebola outbreak from 2018 to 2020. In the UK, the main opposition party is preparing for Prime Minister Boris Johnson to call a general election as early as next year. Strategists believe Johnson might go to the polls before voters feel the impact of higher taxes. Senior advisors have told the Labour Party leader that they should be ready for a snap election next spring. And Bloomberg has learned that top members of the United Arab Emirates royal family directed Tom Barrack's influence campaign for the country in the U.S. The billionaire traveled to the UAE just weeks after Donald Trump's election. Barrack has been charged with acting as an unregistered foreign agent. He has pleaded not guilty. David Kamansky has died at the age of 82. He joined Merrill Lynch as a stockbroker and expanded the firm around the globe as chairman and CEO during the bull markets of the 1990s. He once famously said that the firm's sale to Bank of America, quote, broke my heart. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
This is Bloomberg Markets, the close, a little after 2:30 here in New York. And as always, we'd like to get you caught up on what's happening in that commodity space here. Waiting on settlement right now of NYMEX crude futures, which at one point here actually topped $76 a barrel. We saw Brent actually above 81 barrel at one point here on the day. A little bit of a pullback here. But again, when you look at the move higher that we've seen over the past few days here, down about 0.5%, really not much to sort of get unsettled about. There was some breaking news just a few minutes ago here. Jen Psaki, of course, the White House press secretary, was talking about the move in oil prices and said that the White House continues to talk to OPEC on oil prices. Not exactly sure what that means. We do know OPEC is scheduled to meet on October 4th here, so we'll get maybe a little bit more insight with regards to the supply side of the equation, but really it's demand that's driving a lot of this as well. You're seeing that reflected there in natural gas prices. At one point, we were above $6 per million BTUs here in the U.S. here, now right around 5.7 here, but still seeing a lot of strength, much higher strength over there in Europe as reflected in London as well as in Dutch prices there. Gold futures down a little bit today here on the back, of course, of the rise in the dollar and, of course, the rise in those treasury yields. And something that we don't really talk a lot about here on the show, but talking about it for a second straight day, and that's cotton futures at the bottom of your screen. $1 a pound right now. First time we've seen this in nearly a decade here, and a lot of strategists basically saying that this is going to persist well into next year. It may sound trivial here, but this is having tremendous impact on a lot of clothing suppliers here. And if you thought everything else was expensive right now, including cars, computers, everything else, well, get more to pay for, just tack it on here.
Just a t-shirt
Where's
and
inflation?
jeans, right? But Romaine keeps telling me all this is transitory. So one day we won't talk about it anymore. But Romaine, you bring up a good point when you talk about some of the individual commodity markets that we're looking at. I just wanted to broaden out quickly and just look at the Bloomberg Commodity Index. Of course, nat gas and gold and crude and Brent and copper and corn. Those are all some of the big heavyweights in this index. But you're going back to the highest since 2011. And at that time, that was near some of the record highs that we have seen. So this has been a very big sort of broad-based Bloomberg Commodity Index rally that is underway. Let's do it all with Rebecca Babin, CIBC Private Wealth Management Senior Energy Trader. And Rebecca, I mean, where to start? I guess we could start with oil and nat gas and perhaps maybe what some would say is maybe a small energy crisis underway. What do you make of it?
Yeah, the energy markets are in a little bit of a tailspin right now, and I think it's been well covered by the media what's happening in Europe with the nat gas shortages and the spikes we've seen, you know, some prices rising 300%. Ultimately, I think this comes down to a number of different factors. We can't just say, okay, this is the cause. It's because Europe shifted more to renewables. It's because we ran super low inventories in a cold winter in Asia. We had a hot summer. We drew inventories in the U.S. We haven't had as much production in the U.S. because nobody wants to invest in fossil fuels here. So all the associated gas that comes out of the ground when shale drills oil hasn't been as much because we're not drilling as much shale. So we don't have as much LNG to ship to Asia and Europe. So there's just, it's kind of, and I hate to use this extremely overused term, a perfect storm, what's happening right now. And there's a cyclical component. We've got stronger demand coming out of a pandemic. We've had colder weather. And then there's a structural component, and we've heard this talked about a lot by several analysts in terms of the underinvestment that's taken place in traditional energy.
Rebecca, perfect storm, tailwind, those are some fighting words there. So where does that take us into the rest of the year in terms of how much worse it could get and what that means for prices?
Yeah, so this is where I think I differ a little bit from some of the other calls on the street that think that this could really cause a super cycle or extreme price shock. I think ultimately we could see some moves higher throughout the winter because simply there's no easy lever to pull here to bring nat gas to those who need it right now, especially as temperatures get cold. So we could see continued spikes. I don't think this is something, though, that lasts over this 6-month time horizon. I think ultimately there's going to be political pressure applied, and there is some leverage in that. And it's not just from the U.S. calling OPEC saying we need more crude oil. It's also looking at something like Gazprom. It's also the global kind of community coming together and trying to figure out how we're going to ration. And there is going to be rationing associated with this spike. There's going to need to be, and there's already some of that taking place in China. So I think we actually see normalization happen sooner rather than later, but I know that's a little bit yet to be.
There's a lot of short-term moves right now that we're keeping an eye on here, Rebecca. I want to go back to the comments about the super cycle. I know those aren't your comments. We had Jeff Curry, of course, of Goldman a little bit earlier who kind of talked about this idea. And we've heard this from other strategists here. And their basis seems to be rooted in the idea that there are longer-term structural things taking place with regards to the shift to renewable energy, renewable fuels, and sort of alternative forms of energy that require just sort of a different sort of use of materials and commodities in a way that we didn't have in the past. And when you look at some of those longer-term structural and secular issues here, does that actually presage maybe a little bit more upward price pressure on some of these commodities?
So I think that those are all very valid points, and I think we're seeing those upward price pressures now. So I guess what I would say is we're experiencing that now. That is being priced into what we're seeing at this moment. The fact that we're not ready necessarily to transition the way that we might be mandated to through whether it be investment cycles moving away from traditional to renewable energy and it not necessarily having the infrastructure. What I think about over the longer term, and I think this will hold true, is in a capitalist system, even though energy companies, fossil fuels are not getting their traditional sources of capital right now to invest and continue to produce. If these prices stay here, there will be investment and there will be some bring back or increased supply for fossil fuels in this environment. It's not going to be as traditional, it's not going to be as fast, but I don't necessarily see this structural change that we do see happening over 10 to 15 years happening in 5 years. I think this is something where we're going to have to have the realization we're having now that fossil fuels, and if you look at OPEC's report that they put out today, their world report, they think they're going to be continued, they're not going to plateau for quite some time, and that will require some investment. So I think it's too early to call that this investment is not going to happen in fossil fuels and that structural change is imminent. I think it's a longer process than we might have anticipated.
Interesting. Does that investment that you talk about back into fossil fuels set us back in the goals that, namely, I mean, a lot of the European countries have made, even China, as you're hearing, have been shifting to be more cleaner, if you will? Or can you do it all at the same time to make sure we get that shift, but that we do it in a reliable way?
Right. So that's the great debate right now. But think about this. If the transition right now, when it doesn't work, we have people switching to coal, which is the dirtiest thing, right? Because their renewables aren't working and they're having to switch to crude, and then there's not enough crude because there hasn't been enough production, then they're going to coal. So if you push it too hard, you actually go dirtier than you wanted to. And you profit those industries that you actually wanted to transition away from through higher prices. So it's a balance, and we just haven't struck it. We have not struck that balance yet, and we're seeing that through the price volatility. I think we're going to have to realize that we might not be able to achieve that end goal quite as quickly or as effectively as we'd wanted, and we might have to have some investment in some traditional fossil fuels to help us to make sure we don't have these big tail events.
All right, Rebecca, always great to get your insight there. Rebecca's so smart. Rebecca Babin, CIBC Private Wealth Management Senior Energy Trader here. Coming up here, well, we're going to talk banks. Banks eager to get their employees back into the office, including Deutsche Bank. Shonali, I think you sat down with this person, right?
Yeah, absolutely. It was her first interview in the new Deutsche Bank Center that was formerly the Time Warner Center. 5,000 workers back to New York, Romaine.
Does she call it the Deutsche Bank Center now?
Oh, she sure does.
I'm sure she does. She's Deutsche Bank America's CEO, Christiana Riley. She's going to be joining us. So we're going to hear that interview coming up next. This is Bloomberg.
What have we learned from this ever-growing crisis so far?
From my investment perspective, I think diversification is very important. So far this year, we see many events, right? Maybe in the fintech sector, and education, casino, and property. So I think diversification help you lower your risk on your overall portfolio.
Medium term, though, are you seeing more risk and reward in the high yield space in Asia? I mean, how are you viewing this right now? Are there actually buying opportunities given just the selling we've seen?
This time is a bit different in the property cycle because in the last, when you see there's a tightening measure, there's always demand there, right? Just the government trying to suppress the demand. But this time we're seeing a confidence issue, is like a buyer strike. Because of the sentiment, the Evergrande is hurting the sentiment, and people don't want to buy. And other developer, because they want to get cash.
Watch Bloomberg Surveillance to stay on top of the latest market trends, commodity trends, and fashion trends.
Are you going out for a fitting on a base suit?
I'm going to go and get a base suit. The crowdfund was very profitable.
$100,000.
Came in at about 100K, which is what it would take for me to wear that suit on this network. How do you get that bulky fit? I'll find out. I'll have a chat.
You get bulky,
get the bulky one.
You know, I'm channeling the president.
Look at those markets.
Don't taper the pants. They're
John,
futures
you look
down
so
6.
good in a base suit.
We're next on the
dreaming.
S&P.
I am waiting eagerly for that ultimate approval so that our children can get vaccinated so that we can do all we can to navigate through this COVID-19 pandemic.
Deutsche Bank is planning to return 5,000 workers to New York City over the next 6 months. I sat down with the America CEO, Christiana Riley, earlier today on how the company plans to safely bring people back to work. Take a listen.
We're absolutely thrilled to be opening this building at such an important time for New York City. It's 20 years ago, in the aftermath of the 9/11 terrorist attacks, that Deutsche Bank made the important decision as the first foreign firm to list on the New York Stock Exchange in those immediate weeks after that. And this moment for us up here at Columbus Circle is just as seminal, just as pivotal, because we feel that we're also excited to be part of this return back to the city. We'll be bringing close to 5,000 people back to this office over the course of the next 6 months, and we're absolutely thrilled to be part of that.
You have such an interesting strategy because while some banks are bringing people back in thousands now or in the coming weeks, we've heard that Deutsche Bank still has people coming in 2022, that there's some time for them to come back in.
Yeah, so this whole experience of the last year and a half has been a real leadership challenge, certainly for me, but I know for many in our industry. And we've really needed to think about how do we balance the safety and well-being of our staff with the performance and success of our firms. And we've reflected a lot on that over the last year and a half, always having kind of a principles-based return. That began, of course, in March of 2020 with needing to get, the information that we had at our fingertips back then was get people into their homes and get them safe. As we've navigated through this, science has helped us to know testing helps getting people back in the office. Ultimately, vaccination has been the real key. And so we've communicated really openly with staff throughout this, and are thrilled to now have the confidence with vaccines in place to be bringing people back in person. But as much as we believe, and we very strongly believe in the value of collaboration, you'll see so many examples of collaborative spaces around this beautiful new building. We also understand we've learned a ton about flexible working arrangements, right? And the value that that can have in making sure that we continue to be an attractive employer in this industry.
Well, speaking of flexibility, there's so many people that are bringing people back very quickly, as we had discussed. Do you think Wall Street risks the talent it has if it moves too fast?
So I think we need to clearly differentiate between what we call the return to office versus reimagining the future of work. And those two may not operate on the same timeline, and may not in different pockets of the organization operate on the same timeline. As you say, we're bringing people back over the next 6 months, and we're working through the articulation of that future vision. We've got nearly 80% of our staff coming back to this building with the option to have up to 40% flexible working arrangements. And that's a phenomenal opportunity, I think, to re-envision the way we collaborate one another and what does office space really mean.
So there's also the idea that you've inherited this bank that in the U.S. that is a lot leaner, right, than the one that you inherited when you had stepped in just a couple of years ago. So when we look at Deutsche Bank's presence in the Americas today from a business perspective, what can we expect it to be in the next year or so? Where can we expect it to grow?
So when we met 2 years ago for the first time, Sonali, I told you that my mission was to make Deutsche Bank in the Americas smaller, tough message, simpler, but in doing those two things to ultimately make us stronger. And we're talking now 2 years later, and we're really well advanced on that mission. We've stabilized the platform. We've made difficult decisions around shedding businesses that weren't successful, weren't profitable for us in this market, and we've set the firm on much more solid footing by concentrating on the businesses that are our signature strengths. We've got a spectrum of businesses across the fixed income and credit origination space that are really genuinely of value for our clients, where we're bringing real value in terms of financing growth opportunities in this very dynamic market here in the U.S., and we're very proud of those businesses.
That was my interview with Christiana Riley, the CEO for the Americas at Deutsche Bank. Taylor, over to you.
Yeah, great interview there, of course, Sonali. There are some other big stories, though, of course, that we're following at this hour. We have to start with some of the economic data that we got this morning. U.S. housing prices have posted the biggest jump in more than 30 years. According to the Case-Shiller CoreLogic Case-Shiller Index of Home Values, prices, they're up almost 20% in July year over year. It was the 15th straight month of accelerating home hikes. And two of Canada's largest gold miners, they are combining. Agnico Eagle Mines has agreed to buy Kirkland Lake Gold in an all-stock deal valued at $10.6 billion. It is the latest in a string of similar deals that has reshaped the gold mining industry in recent years. And Japan may kick off the process to sell an $8.5 billion stake in Japan Post Holdings this week. The government plans to cut its stake in the postal and financial services giant to 1/3. That is the minimum it's required to hold by the law. Money from the sale will be used to pay for reconstruction of areas devastated by the tsunami and earthquake back in 2011. And those are some of the other big headlines at this hour, Romaine, that we're following.
Yeah, thanks, Taylor. Nobody does business flash headlines like you. Stock of the hour coming up next. Nobody does it better than Dave Wilson here. He's going to take a look at Huntsman. Huntsman on the rise here. Shares up about 7% here. We're going to talk about how the chemical company plans to engage with its new activist investors, Starboard. That's coming up next. This is Bloomberg.
China, if you look at U.S. taxes, how much time do you spend figuring out these big overarching themes as opposed to what happens with inflation?
There's an awful lot going on at the moment, as you say, and clearly some of the big debates at the moment are the slowing global growth picture, which we're seeing everywhere. And we're also seeing that at a time when inflation is rising and is proving pretty sticky. And to your earlier points, Francine, essentially the interplay between those two is critical. So some of those news events this week, whether it's OPEC and what's happening from a supply perspective, is going to be crucial, or indeed, of course, that US CPI print. So we've spent a lot of time thinking about inflation more recently, because clearly that leads into when we feel you may start to see the taper, and when you might start to see rates going back up, particularly in the US. I mean, what might be useful just to explain a little bit is the focus that we've seen from everybody on China. You know, clearly China, huge in terms of the global commodity cycle.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
All right, let's get right to our top calls and look at some of the movers on the back of analyst recommendations. First up, Wells Fargo downgraded to equal weight. This over at Morgan Stanley. The analyst saying that Fed asset cap timing is going to be delayed more than a year from the company's prior estimate. Shares down here by about 2.4%. Next up, Chewy upgraded to outperform over at Wolfe Research, $90. That's your price target. The analyst seeing strong growth ahead despite a recent decline in some new customers. Nevertheless, Chewy shares down here on the day by about 2%. And finally, let's take a look at Disney. Wells Fargo cutting its price target to $203 from $216, still maintaining that over rate, but the analyst citing concern over what it will take to get Disney Plus to reach those fiscal year 2024 subscriber numbers that the company is guided to. Shares down about 1% on the day, and those are some of our top calls.
Thank you, Romaine. In the meantime, we want to get back to our stock of the hour. Chemicals maker Huntsman has a new vocal partner. As activist Starboard Value takes a sizable stake and is ready to shake things up. Bloomberg, Dave Wilson joining us now to shake things up. What do you know about the stake?
Well, we know it's 8.4% of the company when you figure in not only shares, but also some forward purchase contracts. Not unusual for this kind of activity. You're talking about, if you put it all together, the second largest shareholder in Huntsman behind Vanguard. You also see BlackRock, Capital Group. I mean, they're all tied into mutual funds. So you'd expect to see those kinds of firms at the top of the list. Then the Huntsman Foundation itself. We have to remember the family still has an interest in this company, even if they aren't necessarily the top management. We also know Starboard paid about $26 a share, roughly, when you go through their holdings. And you're talking about a stock at $30 now. We also know that, Starboard has a history of seeking change at companies. And, one possibility as far as change goes is kind of focusing in on different segments of the business. The idea that, that they make textile dyes and chemicals. It's only 10% of their revenue. Maybe that's an area that we see something happen. At least the analysts are sort of anticipating that. But we also know it's a company that has struggled over time to sustain revenue growth. They had declines the last 2 years. Analysts looking for something like a 29% increase this year. But you go to next year, the year after, not much revenue growth at all. So, the real question is, what happens as a result of this relationship with Starboard Value that may change the nature of the business and so therefore may affect the top line as well as the bottom line?
David, like you said, the revenue had stagnated for a long time here. So why should Starboard go after Huntsman in the first place?
Well, because you're talking about a stock that hasn't done so well relative to its peers. At least before today, when you got the jump in the share price. So, you look at the last few months, it slipped a bit. So, whenever you see those kinds of declines, it opens up opportunities. And so clearly Starboard saw one in Huntsman, and we'll find out what develops. I mean, Huntsman said they look forward to a constructive dialogue.
All right, Dave Wilson there with our stock of the hour, Huntsman there. Okay, all right, let's check on here on the broader market here as we get ready to count you down to that final hour of trading here. Stocks off the lows of the day, but still deep in the red. Of course, the big sell-off coming with a lot of those big cap tech names. Cyclicals really not providing much support.
Even though it is a reflationary trade, all the vogue, if you're looking at bond yields, you're up 4 and 7 basis points on the 10 and 30s. Yields are rising for 4 straight days. This is Bloomberg.
There is just a lot of demand right now for products, whether those be items for our home office or for backyard entertainment. This has been a consistent issue for the past year or so throughout various lockdowns. The global supply chain is made up of ships and trains and trucks, and it's designed for predictable patterns of demand, which is the exact opposite of what we have right now. A lot of uncertainty about whether certain economies are going to be open or closed based on the outbreaks that they're having. So we're just seeing a lot of confusion, a lot of chaos, and a lot of uncertainty disrupt the whole system. The auto industry is very reliant on semiconductors, these memory chips that are in basically everything we buy that has sort of an electronic component to it. And they come from certain economies in Asia, like Taiwan, where they're having trouble meeting the demand. The supply chain issues are going to be around as long as you think the virus is going to be around. First or second quarter of 2022 is when a lot of people see the normalizing of all the shipping and transportation disruptions that we're seeing. But if they don't, we might be dealing with this for another year or two or three.
Basic economics is, for all countries, in all time, is that if your debt is in your own currency, you can deal with it. You can work it out. You could work it out. We've seen it happen over and over again.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
I'm Mark Crumpton with Bloomberg's First Word News. European nations dominate the top of Bloomberg's COVID resilience ranking for a third month. Ireland is now at the top of the survey, while the previous number one, Norway, fell to the 10th spot. Ireland has been steadily moving up since the start of 2021, when it had the worst outbreak in the world. Meantime, the Delta variant has left the United States reeling. It fell 3 spots this month to number 28. Pfizer and partner BioNTech said they submitted initial data to U.S. regulators about the use of their vaccine for children ages 5 to 11, coming a step closer to bringing shots to school-age kids. The companies expect to make a formal request for emergency authorization in the coming weeks. Submissions to regulators in Europe and elsewhere are also planned. Wall Street's money is apparently on Florida Governor Ron DeSantis and not former President Trump when it comes to the likely Republican presidential candidates. 1/5 of the $55 million DeSantis has raised came from finance industry types like billionaire Ken Griffin. Former President Trump raised most of his $100 million from small donors. Less than 2% of his 2020 donations are from Wall Street. The UK has put the army on alert to help deliver supplies to gas stations. It's the latest emergency measure in a crisis that has engulfed Prime Minister Boris Johnson's government. Supply chain disruptions have drained gas pumps, emptied some supermarket shelves, and disrupted businesses. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
The most crucial moments in the trading day. This is Bloomberg Markets, The Close, with Caroline Hyde, Romaine Bostick, and Taylor Briggs.
This is the countdown to the close. About 58 minutes left to go in the trading day.
And unfortunately, Sonali, it is still pretty much red on the screen for both equities and bonds.
Absolutely. We have most major sectors here in the red, Taylor. We have information, technology, communication stocks leading the way. As we know, the NASDAQ is also in the red. Energy, the only sector in the green. Romaine, I know we'll talk more about that as we have been all day.
Well, the interesting thing about the energy, I mean, you're seeing that in the green, but it's kind of a tale of two cities here. You're looking at a lot of the oil and exploration companies, exploration and production production companies, I should say, are actually in the red on the day. It's actually the oil services stocks that are getting a big boost. Names like Halliburton, Schlumberger, Baker Hughes, all higher here on the day. That's really your only bright spot on the day. Ford, actually a bright spot as well here. In fact, Ford's actually been on a pretty good run now, up for a fifth straight day. A lot of this seems to have to do with their latest push towards building out their own battery capacity. 3 new factories down in Kentucky and Tennessee just for batteries alone, and a 4th factory for an assembly plant. This is going to be their first assembly plant built here in the U.S. by Ford since 1969. That's a big deal here. But then look at the top of your screen. This is really the narrative right now. Big tech taking it on the chin right now, as is Moderna and a lot of the stocks in the healthcare space here. That's the sell-off.
Indeed, and I wonder when we talk about the sell-off, how we're thinking about correlations as well. I know Amy Wu Silverman, who we have next, nails it every time when she does puts and calls and derivative analysis. We're going to not try to do that because she does it so well. But along those lines, Romain, what's really interesting is we take a look at the VIX, the equity vol, and then move, bond vol. And what's really interesting is you're getting zero correlation. Historically, of course, we know you get a lot of positive correlation during big market sell-offs. Everything sells off together. The market is totally correlated. But then, of course, you get these dip periods when you actually do see some negative correlation, and maybe bonds provide a hedge for equity. But in this case, when you think about the volatility of them working together, right now we're pretty much zero. And you wonder if you start to see some positive correlation come back during periods of maybe a big broad-based sell-off, or if you could actually get some hedging protection within one of these indices, Romain.
All right. Well, let's bring in the person you were just saying was going to be here. Amy Wu Silverman, equity derivative strategist for RBC Capital Markets, joining us right now. And Amy, I do want to start off here with the sell-off of big tech, I guess if you want to call it a sell-off, but they've certainly fallen out of favor, at least for the last few days here. And there does seem to be this sort of round robin that we've seen over the past year and a half where people decide that they want to be in cyclicals and not in tech, and then they get scared and they go back into tech here. When you look at some of the patterns that we've seen in this market, do you see that the current cycle persisting maybe a little bit longer?
Yeah, it's funny you should say that, because we're trying to read the tea leaves, and every time yields goes up and this happens, I kind of say, well, I'll see it when I believe it, when we really get some persistence in that, sell-off continuing in tech. I'll tell you one fact that I think is quite striking to me today, which is, in the past month when we've had drawdowns in S&P, let's say, the normalized skew levels, so essentially that demand for hedges, that demand for downside, keeps rising. So as the market was worried, you essentially saw more worry pile in. You saw more investors buying those hedges. We're consistently not seeing that today. We're not seeing that in S&P. We're not seeing that in Qs. We're not seeing that in the software and the semis ETFs. So essentially, people are not buying more hedges even as tech sells off. Look, is that a bullish signal? I don't know. But it is very interesting because in past drawdowns, we've had that fact, and it is not occurring today at all.
Are you getting some of the why in answer to that question? Because higher bond yields are showing you that higher growth and higher inflation actually isn't a reason for equity investors to worry.
Yeah, it's a great question. I think, look, the reality is today, at least from the conversations that I've had with clients, people are still digesting a number of things. One of the main things they're digesting is that we've had these 2 resignations in the Fed. And so, one thing I said in a note today was we've kind of swapped Fed's regular volatility for DC volatility. And that tends to be more volatile than just regular old Fed volatility because, now you have someone who's going to be picking someone to replace Kaplan and Rosengren. And we know how, the Democrats have leaned. So, it's interesting to me that we're getting this reaction today when, arguably you could say that we're actually down a much more dovish path in terms of what that dot plot could look like with the people who would be replacing these guys.
Amy, it just seems like the list of worries keeps on growing into the end of the year, and I'm wondering at what point it reaches a tipping point. When you look at the next couple of months, what are you most concerned about that can really have investors flocking back to those hedges you're talking about?
Yeah, one thing to me that I guess I'm concerned about because it's been so absent, Taylor, is there's really been no retail call option buying. There's been no retail stepping in. I guess I got a little comfortable with it because in the last 18 months of the pandemic, these guys have always been here. They've inverted our skew levels. We can count on them, especially in mega cap tech. this is noticeably absent. Yesterday was the first day I've seen in the S&P 500 where we didn't get a single skew inversion, essentially where that call implied volatility flips higher than the put implied volatility. So, a concern may be kind of the absence of exuberance, if you will, rather than kind of more growing concern for downside.
Are you seeing, though, more hedges sort of start to pop up?
So not really compared to other drawdowns. Hedging, the market was very well hedged. Skew was very high. It was very well positioned. But as we've seen these drawdowns today, you have not seen people saying, I'm gonna roll these hedges further down, for example. I'm gonna initiate new hedges. You're not seeing as much of that. You're seeing skew levels decline, albeit from high levels, but they're all still declining, kind of from 99th percentiles to back to the kind of the 75th, 85th percentiles.
Amy, we're having a lot of conversations during previous 2% drawdowns that 3 or 4%, it was the new 5 to 10%, because you couldn't get 5 to 10 because you had those retail investors, as you mentioned, come in and buy the dip. If they're not stepping in a big way this time, what do you see as a new level for some of these big drawdowns?
Yeah, it's interesting. I'll actually kind of answer this in a more roundabout way. I think what they're going to keep from happening is, it's going to be more of a cap to the upside rather than a severity on the downside. So, this is kind of a compelling environment if you don't want to pay for those hedges to overwrite, right? To sell those calls on the market, because in the past, when you've seen that call exuberance from retail, you really couldn't overwrite. You couldn't sell those calls because they would kind of blast through those levels, even though they looked expensive. So, I don't know that this changes the magnitude as much on the downside as it makes that upside kind of more heavy and not able to be blasted through.
Amy Silverman, equity derivative strategist for RBC Capital Markets. Really appreciate your time and your comments there, especially on days like today. Coming up, we're going to keep continuing to watch these markets into the closing bell, and we're going to do it with Richard Bernstein, CEO and CIO of Richard Bernstein Advisors. Plus, Jerome Powell defending Fed policy in testimony before the Senate, saying tapering is not tightening, and there's a big distinction between the two. But that doesn't keep bond yields from jumping today, as you're seeing stocks retreat. And investors in China, they are continuing to buy cryptocurrencies in spite of Beijing's crackdown. We have that debate over crypto regulation, and we're going to do it with the CEO of the digital payments company, Circle. All that more coming up. This is Bloomberg.
Can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it, because every decimal point of rise in temperature, it is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The growth story in cannabis remains very strong even after the sort of the loosening of the pandemic. There was a worry that that there might be wallet spend competition. But so far, the cannabis sector seems to be holding up very strong.
This is the countdown to the close. 47 minutes left to go in the trading day. You remember last week we were talking about the S&P, of course, breaking below its 50-day moving average and then climbing to reclaim it. Well, we're back there once again here on the S&P 500. Of course, you're seeing a lot of this being pushed down by the weight of some of those big cap tech names, which continue to be weak. But you're really not getting any help here from the small caps or the mid caps as well. The Russell 2000 right now looking up at its 50-day moving average right now. Flip up the board. Of course, a lot of this being driven by what we're seeing in the Treasury space, in the bond yield market. 154 right now on your 10-year yield here. And this isn't really providing any sort of reprieve, particularly on a day when you're getting that type of strength in the dollar. You can see even the KBW Bank Index, which is coming off a pretty good run here, even that's not able to get a boost here off of this yield environment. And then there at the bottom of your screen, you're taking a look at the VIX, elevated once again right now, camped out above 20. And on that note, we should bring in Abigail Doolittle for our Options Insight segment. We bring her in every day at this time for Options Insight. And Abigail, I took a look at the VIX, and you talk about some of the elevation we've seen there. I seem to remember a few months ago, everyone was saying the VIX really wasn't as good of a barometer about fear or the fear gauge that it used to have here. But it does seem to be sending a pretty clear signal right now.
It certainly does, because if we look at it over the last couple of months, we're looking at higher lows, which means that folks are getting a little bit more fearful with each move higher for stocks, and then also higher highs. So basically just more volatility, building slowly but surely. And I would argue around rates as stocks try to digest rates. But let's talk more about the VIX and this spike that we're seeing in particular today with Mark Sebastian of OptionPit.com. Great to have you with us as always, Mark. And it's pretty interesting because just a couple of days ago, the VIX was back down, I think, at 17 or 16, now at the highs of today at 24. So we're back in last year's range. Do you think that the high side of last year's range, which is at 40, do you think that's in play, or we're going back down out of the range toward 15?
You know, I still think we're probably heading back towards 17 later in the week. We were briefly in a partial backwardation with the cash index above the futures this morning. That has flipped back out. Futures are now trading at a premium to the VIX, which generally points toward a bottom of the market and a top in volatility. We tested the lows from last week, the low close from last week, and found a bounce there. So these sellouts have tended to lead to the buy the dip crowd stepping in and running the S&P higher and the VIX lower, at least till 17.5, 18, and I think that is in the cards again for the rest of this week.
Okay, so that's the near-term call, but do you think that as we bounce between, let's call it 25 and 17, do you think that that's setting up a move, especially because there are those higher lows suggesting that some of these vol traders are getting a little bit more anxious for a bigger volatility event? Do you think that there's something bigger ahead, or that this just fizzles out, that stocks will be higher at the end of the year based on what you're seeing with options?
Well, there is a ton of hedging in way out of the money puts on the street out there. They're buying a lot of cheap puts. That's one of the things that's been holding up the VIX. The thing to be aware of, though, is that if we do get some sort of event that is able to break us out of this S&P range of, tapping the 50 and then bouncing, and we really get a push, market maker positioning could force a lot of selling, and that's how something like that could cascade. So keep an eye on the 50-day moving average. If we stay under there for a couple of days, that's where I would start to get scared and start to be looking for maybe a test of 200, maybe a test of 4,000. But it's going to take a real push for us to break that because the street is holding so many of these cheap out-of-the-money puts.
Well, it's interesting that you're talking about those cheap out-of-the-money puts, because it always makes me think of this skew index. And in about 20 seconds or so, Mark, a lot of professionals that I know don't like it because it's not always accurate. But over the last couple of corrections, when the skew has gone higher about a month later, there is a pretty decent sell-off. Do you see any possibility of that?
Yeah, the skew index has its flaws, but it is valuable in that when that thing is really, really high, that's a sign that the market is really positioned for, to protect themselves, and they're worried about a crash.
Right.
So, yeah, there's definitely some logic to that approach.
Well, you had a great call back in February of 2020, so if there's a crash to come, we'll want to be talking to you. Mark Sebastian of OptionPit.com, thanks so much for joining us for Options Insight as always. And Taylor, back to you.
And thank you, as always, Abigail. And stay with us, because up next, we're going to get a lot of insight into the cryptocurrency crackdown in China. Still some further ripple effects from some of the big news that we got at the end of last week. We're going to do it with Jeremy Allaire, CEO of crypto exchange Circle. This is Bloomberg.
From New York City.
We're here in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone. Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Who are U.S. Open tennis champion Emma Raducanu's 3 dream dinner guests?
Daniel Ricciardo, Michael Jordan, and Tom Keane from Bloomberg.
She understands you.
Funny and very understandable.
I am reading in on tennis like nobody.
Yeah. Champion approved Bloomberg surveillance. Mornings on Bloomberg Television and Radio.
Take a look at the sell-off that we're seeing a little bit in some of the crypto assets as we look at the broader sell-off underway as well with both equities and bonds. But they're still within that long-term uptrend, and that's where we really want to go in our emerging action segment with Sherry on, of course, the co-anchor of Bloomberg Daybreak Asia and Australia. And it's interesting because this all started stemming from the big news that we got from Beijing on Friday.
Yeah, it's really interesting to see that we haven't seen that big of a move since that announcement on Friday. We're sort of similar levels to where Bitcoin was when we heard from the PBOC that they were going to be banning crypto transactions, that they were going to be closing that loophole that allows citizens to maintain accounts with offshore exchanges, rooting out mining of digital assets. And you can see Bitcoin's wild swings historically is not that big of an episode right now. And we continue to see these buyers jumping into the market. We're talking about investors still turning to other ways to keep trading in cryptocurrencies. We have heard from some that they're using MetaMask, which is this digital wallet for online game users to buy and sell non-fungible tokens that also allows the trading of cryptocurrency. So we continue to see these investors buying in to the digital crash last week. For example, CoinShares now saying that Bitcoin actually was bought the most in 4 months after the crash last week. And already, of course, we have seen perhaps that China is not necessarily thinking that crypto will fail. They're more thinking we want more control over this industry worth trillions of dollars, right? So we have seen now this cross-border experiment of digital currency backed by the Bank of International Settlements and the monetary authorities of China, Hong Kong, as well as Thailand and the UAE, that shows that e-cash can lead to faster and cheaper global money transfers.
Well, Romain likes the meta, and I like your standard deviation chart. So we get 2 for 1 there from Sherry on, the co-anchor of Bloomberg Daybreak Asia. And let's continue this conversation, of course, with Jeremy Allaire, the co-founder, chairman, and CEO of the digital payments company Circle. And Jeremy, what's interesting and what Sherry sort of alluded to is there wasn't actually a lot of big new news on Friday. China's been hinting about control and cracking down on the crypto segment really for years now. What changed for you, if anything, from that news at the end of last week?
I think there's some really significant things. First of all, as you noted, right, I think this is the 8th time that China has quote unquote banned crypto. And there's a lot of folks that have circulated various charts that talk about, the percentage growth in Bitcoin specifically over those periods, after those periods. And it's really just been this constant up and to the right overall. I think you saw that, right? You saw this news, and then I think you saw people shrug it off, and basically the markets were rallying pretty hard until some of the broader sector kind of activity has happened with interest rate concerns and everything else. But I think the big thing that I want to emphasize here is there's some major lessons here. And I think the major lessons are lessons for U.S. policymakers in particular, which is, this technology in particular is a technology which empowers individuals. It presents opportunities for economic freedom. It is a decentralizing technology. And so systems that are highly centralized, that want to eliminate privacy, that seek to have control over private markets, are, of course, very threatened by this. And I think this is a lesson for the West, which is grounded in those ideas, fundamentally, grounded in those ideas. And so I think
I am curious, though, Jeremy. I mean, this is there's certainly a lesson to be learned here. I also think that, none of us are naive. We understand the power that comes with having control over the monetary system, over currency. And I'm wondering, are you worried at all about the response by U.S. regulators, whether it's the SEC, the Treasury, or the Fed, and their attempts maybe to, maintain that power?
Well, I think we're actually seeing the opposite happen. I mean, I think what we're seeing, and this has been happening over the last couple of years, and now it's, I think, really coming forward, which is that major financial regulators in much of the world, in many parts of the world, are acknowledging that, for example, stablecoins, which is a core, technology and operation that we're quite involved in, that stablecoins represent a fundamental payment system innovation, have the potential to significantly improve how not just value transfer works, but ultimately can be used in broader financial market infrastructure. And you're seeing regulators step in to say, hey, this is getting huge. This has grown to over 100 billion in circulation just this year. It has the potential to be, a trillion in circulation, and there ought to be a federal supervisory framework around it. That's not a crackdown. That's not trying to, kind of crowd it out. It's actually acknowledging that this is a major innovation in the U.S. financial system.
Jeremy, on one hand, it's easy to understand the relationship to the dollar here, but on the other hand, there's that concern about any potential run on the bank-like situation. What confidence, and really within a minute here, can you give regulators that won't happen?
Well, first of all, a stablecoin like USDC has always been operated under banking regulator supervision throughout the United States, and under specific statutes that require a very, very narrow range of backing on a one-for-one basis at all times. That's a regulatory framework that applies to PayPal. It applies to Square, it applies to Circle, it applies to all these types of firms, and it applies to stablecoins. Now, the next step here is really, doing that at a federal level, doing it at a national level, and ensuring that you have at all times, cash equivalents, short-term U.S. government obligations, which is exactly what backs USDC today. And I think that gives everyone the assurance that this is a real full reserve form of digital money.
Jeremy Allaire, CEO of Circle. Really appreciate your time and perspective on crypto markets that continue to see some shakiness, Romaine, within the midst of a broader context of this market as you're looking at now. It is a Russell 2000 that is the big, I guess you could say relative outperformer relative to the NASDAQ 100. Despite yields climbing all across the board, it is a rate of change kind of day.
Yeah, I think the velocity. Remember, we used to talk about velocity a lot?
Yep.
I think we're going to be talking about that shortly.
Second derivative. This is Bloomberg.
are in a debt trap. It's not just fiscal dominance, but when central banks are going to want to essentially phase out unconventional monetary policy, given the debt ratios, there is a risk of a crash in the bond market, in the credit market, in the stock market, in the economy.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I'm Mark Crumpton with Bloomberg's First Word News. The top U.S. military officer told Congress today that he knew former President Donald Trump wasn't planning to attack China and that it was his job to reassure the Chinese of that fact in those phone calls that triggered outrage in Congress. General Mark Milley, chairman of the U.S. Joint Chiefs, defended the calls he made to China, saying he was responding to what he called concerning intelligence that China was worried about an attack. The general told his Senate committee he was contacted by a top U.S. official.
Speaker of the House Pelosi called me to inquire about the president's ability to launch nuclear weapons. I sought to assure her that nuclear launch is governed by a very specific and deliberate process. She was concerned and made various personal references characterizing the president. I explained to her that the president is the sole nuclear launch authority, and he doesn't launch them alone.
General Milley told the lawmakers, quote, I am certain that President Trump did not intend to attack the Chinese, end quote. The trading scandal that rocked the Federal Reserve now offers the chance to reshape it. After 2 regional chiefs quit, there are now 6 top jobs open at the central bank. The presidents of the Fed branches in Boston and Dallas, Eric Rosengren and Robert Kaplan, have announced their retirements. That's following embarrassing disclosures about their trading activity last year. Japan will lift a virus state of emergency at the end of this month as new COVID-19 infections recede, easing restrictions that have dragged on the economy and limited operations at bars, restaurants, and entertainment venues. The Prime Minister, Yoshihide Suga, said he would end the restrictions on Friday for Tokyo and 18 other areas that make up about 75% of Japan's economy. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
The most crucial moments in the trading day. This is Bloomberg Markets The Close with Caroline Hyde, Romaine Bostick, and Taylor Briggs.
This is the countdown to the close. 27 minutes left to go in the trading day.
And Romaine, you kept telling me yesterday and today you think it's an equity day. Shnali, it's a bond day.
Finally, it really is, because if you take a look at how badly the stock market is actually doing right now, we have most sectors in the red. Even energy, by the way, guys, that was up more than 1% on the day. Now it's up less than half of 1%. So we are seeing a down day mostly all around.
Yeah, not a lot of juice out there right now. You talk about Alphabet here. I mean, we talk about the big breakdown and a lot of those big cap tech names. Alphabet actually on pace right now to close below its 50-day moving average, something that hasn't done in months here. You're seeing a lot of the semiconductor equipment stocks also lower here, not only getting dragged down by the broader market sell-off, but there was some relatively sour research out by earlier today here about the idea here that a lot of these companies may have reached peak cycle here. And then we talk about sort of the move in bond yields and how that folds all into this, Taylor. We know that part of this is because, right, as yields go higher, that sort of erodes sort of the future earnings for a lot of these companies. That's why you see an Alphabet down here. But what about a Snap when you got little to no earnings? What does that mean for those types of companies? So you're seeing a lot of these second-tier tech stocks actually sell off more than some of the big cap tech stocks because, look, there's a little bit less here to erode, if you know what I mean.
We're going to do a quiz on discounted cash flow later.
I can't wait for it.
Just for you, 5 p.m. after the bell.
5 p.m.
But Romaine really hit it sort of right where I was going. When he was talking about yield higher, we're taking a look at the TLT. That's the bond ETF. ETF. And of course, we're going to use that in price. So when that is going down, as we're seeing, that is the yield going higher. So just we'll have to think about that in reverse days. We usually speak about yield. But take a look at this, because we did this with the 10-year when it was the yield above the 50 and the 100-day moving average. Here, at least on the TLT, that's that long bond ETF, you're below the 50 and then now the 200-day moving average. Romaine, that has been sort of this key technical signal that a lot of traders have been looking at when you take a look at some of those ETFs and the sentiment around those bonds. What was interesting is we also spoke to a lot of guests this morning throughout the day on Bloomberg TV about what they've had to say about the jump in bond yields. Take a listen.
You've got a 10-year yield at 1.5%.
I'm kind of questioning what took so long.
It's been a little overdue.
Decomposing what's moving the 10-year yield.
We seem to have a bit of clarity now on tapering.
A market really edging towards reflation.
There's been some unusual price action.
Powell has really spoon-fed the market.
That's obviously true in the bond market.
The steepening in the yield curve
makes a lot of sense.
They've telegraphed the tapering.
Do look for the 10-year yield to continue moving higher.
It's going to be an extended rise.
Rates should be moving higher.
It's just going to get tougher as we go forward.
Some days are going to be pretty uncomfortable.
Some days are going to be pretty uncomfortable. Let's get uncomfortable with Liz McCormick, Bloomberg senior FX and rates reporter. And you heard it there, right? That some days are going to be painful when you get these 10 basis point moves. And yet it has sort of been, as the guest said, what took so long? We've been waiting for this. What do you make of the moves?
Exactly. And what a great round of clips that everyone is talking about this, like something people have been saying for a long time, yields are going to go, and they hadn't, and finally they're going. And, you hear a mixed mash of reasons, but they all gel together into like Blake Gwynn from RBC was saying in a note, listen, yield just keep going higher, and he sees them like 1.25 at the end of the year. And I think that's it, that like everything we chatted yesterday on continues, and there's more stuff pushing yields higher. So it just seems to be kind of the zeitgeist right now.
Yeah. Liz, I mean, how much does some of the short-term issues might be driving this? You talk about the compressed auction schedule that we had this week. You got the big sort of month-end, quarter-end rebalancing here. Is that having an effect here on the move that we've been seeing?
Well, yes, right. And we kind of chatted yesterday that we might have fits and starts, although we didn't have any fits today, or whichever way you call a fit, but we're going higher again today. But I think you're right. And some of the technical things, like we pushed through, like Taylor was talking about the 200-day moving average on the TLT, but even some of the technicals on the yields on the 10 and the 30, people were saying, wow, we were never going to get through 1.4 on the 10s, and we did. And so you're seeing more shorts come in, and people maybe who were on the sidelines and got burned. We had a short covering rally a few months ago. People kind of got out, and people reshorting. So I think this may calm down. I still think the jury's out on kind of the speed. And Taylor, you kind of scared me into remembering my college calculus days, second derivative, I heard you say before. But
yeah, I just like to do that to make Romaine nervous, too.
Yeah. Oh my God. How many nights up studying calculus? We can't go there. But yeah, the speed of the move. I mean, it continued into today, but it just seems like it can't go on like this without abating. We'll see. We did have this bridge auction schedule. We get through that. The 7-year went kind of okay today, so that's the worst of it. But we have things that we don't see coming. That we heard Elizabeth Warren on Capitol Hill today talking about she won't, put her support behind Chair Powell. So that is disconcerting to some. It's kind of, will he be reappointed or not? We did hear, I believe, James Bullard earlier today said, he might see 2 rate hikes next year. So that kind of ginned up the market. So just when you think you know everything, you're trying to digest, something else comes in.
Right. So a lot of that rhetoric around the Fed, we were talking about those vacancies yesterday, a heck of a lot. And then we were also talking to the Deutsche Bank U.S. CEO, who was telling us that she believes that they should move faster to fill those vacancies, given the uncertainties it's causing. So how is that baking into how traders are behaving and how they plan their moves in the months ahead?
Well, exactly. It's funny. I was joking with an editor who was saying, those reappointments are going to take a while. But I think you're right that there's a feeling that because the Fed credibility is a little bit on the line, they want to reappoint those as soon as possible. We might have in the next round of dots the new officials there. And we touched on that yesterday, that these dots we saw that are hawkish, we don't know how's that going to unfold. And I think that's added to, I spoke to an analyst today who was saying, we also see term premium rising in 10-year Treasury yields, which is another kind of, call it wonky, nebulous math thing, kind of a residual. But that's all about uncertainty, from the Fed makeup to what happens with so many different things. The debt ceilings in there. You just keep adding to the list.
All right, Liz, always great to get your thoughts. Liz, we'll catch up with you shortly. Liz McCormick, Bloomberg Senior FX and Rates Reporter here, looking at a 10-year yield camped out right around 154 basis points. Of course, with a lot of talk here about what we're seeing in the belly of the curve, and of course, a lot of talk about what we're seeing in equity markets right now. The NASDAQ 100 right now pretty much camped out around the lows of the day.
And getting some pretty decent dollar strength underway. I'm glad that you put that up there. A lot of the notes this morning highlighting that this is obviously not a risk. Well, you could argue maybe today it's a risk-off move, but it is a last central bank easing kind of move as well. We'll do
Richard Bernstein coming up after the break.
He is. We'll get his comments.
How's that for a tease?
Well, there you go. That's all you need to know.
You don't need calculus for that.
This is Bloomberg.
The electricity subscriptions, it's a part of this new business area that we have called the clean energy services. So the purpose with this new business area is to contribute and to create this biggest movement in the world for renewable energy. We will add even more products. We have solar panels that we sell, and now we have the electricity subscription. So it really fits that ambition that we have to, within the frame of life at home, the most important place in the world, we can add more value to our customers to live more sustainably. And this is a big part of the climate positive strategy that IKEA has for 2030, that we will remove and reduce climate emissions more than we emit in our entire value chain.
Yesterday, you had the biggest underperformance by the NASDAQ relative to the Russell 2000 going back since March. But today, you're getting a similar theme. You're also getting NASDAQ 100, big underperformance that you're seeing. So we're extending the theme of what we saw yesterday. Here's the big theme. Romaine tries to throw me some shade and say boss move to throw up the 7-year yield. But we know, of course, that there was an okay auction within the 7 years after a weak 5s and an okay 2s. And that's also certainly pushing up the 5-year an additional 5 basis points today to a 154. I want to do all of this and more with Richard Bernstein, of course, the Chief Executive Officer and Chief Investment Officer for Richard Bernstein Advisors, who will be with us through the market close. Talk to us a little bit about what you're seeing from the Fed, the impetus, the catalyst of what we took away last Wednesday that is now sort of shaking up these markets, albeit 4 days later.
Right. So, Taylor, I think one has to remember that the Fed is a lagging indicator. And so as we have seen the economy get stronger over the past several months, not even, almost several quarters now, what we're now seeing is the Fed reacting to that strength. And so interest rates are starting to go up. Remember, they talked about tapering and everything. So long-term interest rates are going up. And what you're seeing is the natural reaction in the asset classes that were very sensitive to lower interest rates, right? At RBA here, we've been talking a lot about a bubble in long-duration assets. You're starting to see that if you think rates are going up, you're starting to see that bubble deflate.
Yeah, and that seems to be the rotation that we're seeing. Sit tight for 1 second, Richard. We need to reset here. We're in conversation with Richard Bernstein, CEO and CIO for Richard Bernstein Advisors. He's sticking with us, of course, as we count you down to the closing bell. Take a look here, what's happening in the market here. And this really gets to a lot of what Richard just mentioned here, the idea of a lot of people kind of bailing on some of those long duration trades. It looks like, based on the Russell 2000, they might be bailing on some of those short duration trades.
And Shanali, this sort of folds into your world of the financials and what you're noticing with the steepness of the yield curve. As Mr. Raphael Bostic says, the steepness should continue.
But unless the market stays hot and volatility stays under control, the banks don't benefit no matter what happens to that yield curve. So, yeah, perfect conditions we're looking for, Taylor.
Really interesting, though, Romaine, you're not seeing spreads totally widen out at this moment. I know we'll get to that next as well.
Yeah, we'll talk about that move. We'll talk about that steepening. Look at the dollar. This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The boosters work, and they would definitely help. The boosters, both the Moderna and the Pfizer booster, take antibodies back up to at least where they were, and probably twice or 4 times where they were at the peak. It's definitely teaching your immune system to recognize Delta better. The antibodies that people are making after a booster, they are better antibodies. And they're also probably then better antibodies at recognizing other variants in the future. If you get infected once, your immune system says, all right, here's how much I want to set aside of memory, right, to not get that again. You get infected twice, your immune system says, well, that didn't work, right? It should probably up that some. You get infected 3 times, your immune system's like, all right, this is a problem. It's really worth not getting sick anymore. And so the vaccines are essentially that, right? And if the immune memory was pretty good after the second one, what's probably going to happen after the third one is that it's going to be more stable. Even if the peak is the same, you're going to keep more of it for a longer period of time. It's a race, right? It's a race between the virus and your immune system.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lines in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is the countdown to the close. I'm Romaine Boston.
I'm Taylor Riggs.
And I'm Shonali Bassick. Caroline Hyde is off today.
And as she is, we always do this. We still have the lines chart. And frankly, the picture doesn't look good. The spread had been a little bit wide as you take a look at the big three, the S&P, the NASDAQ, and the Russell. But it's all been pretty negative on the day. And as you can see there, Romaine, it is certainly at the lows of the session in a pretty broad-based sell-off of, well, now almost 3%.
Yeah, and in fact, you talk about the S&P 500, the tech index and baked into the S&P 500 right now down 4% over the past two sessions here. That's the steepest two-day decline that we've seen really going back to March here. The semiconductor stocks weaker as well, largely because of the semiconductor equipment manufacturers here. You're also seeing the biotechs take on the chin as well. And of course, the one bright spot still appears to be energy, though this is sort of compartmentalized just a little bit, Taylor. You're seeing a lot of the oil services stocks rising here on the day while
Bernstein Advisors. And interesting, we left the last segment talking about sort of the macro and the Fed and policy. And I'm curious on days like today's, we're thinking
it would be which side of the seesaw you were on. And so my argument has been on one side of the seesaw, you have tech, innovation, disruption, all the sexy stuff. And on the other side of the seesaw, you have practically everything else in the world. And so what you're seeing is that transition. Now, the market's under pressure, obviously, because the market has been valued pretty highly. We're seeing interest rates go up. But the big story, I think, continues to be which side of that seesaw you're going to be on. And you even mentioned just a second ago about oil services in the energy sector.
And basically